The Hedgeless Horseman here. It's December 21st, 2022. Yesterday we had a big rip in most metals. I think silver was up for 4 or 5% or something. Gold climbed over 1800 again, and yeah, pretty wild day actually. And today it's, I mean, pretty much holding. Well, most of the gains, at least, up a lot in the last 24 hours. But you'll notice, these are volatile markets. I mean, the silver can be down 2% tomorrow, up 2% the next day, down 3% the day after that, and then up 4%, etc. I mean, it's really wild times, which makes it very easy to, if you always want to be correctly positioned for the short term, you'll end up, in my opinion, chopping your legs off, because this volatility is, I think it's pretty much untradeable. And like we've seen, if you're invested in miners, they have a life of their own anyway. So it doesn't make much sense to first of all try to guess, let's say, where metals are gonna be trading every day. Then you have to be right where miners are trading relative to what you expect from the metals. So it's basically a guessing game within a guessing game, and I don't like that at all. I think that's the sure way to end up like everyone ends up almost, meaning constantly trading, selling high, selling low because you think it's going to go down, buying high because you think it's going to continue up. Meanwhile, I think the most straightforward and simple strategy is really to just look at what am I paying right now, and what is it worth, and what's it gonna be worth in, let's say, 1 or 2 years. Because I mean, the funny part is, again, it's like only maybe 2 months ago, everyone was in distress, so no point of owning miners. And 2 months later, it's getting quite, somewhat bullish again. This looks like it might be a, big bull flag in silver, and it's about $24, which is obviously, close to multi-year highs, as you can see here. So I mean, just like that, 2 months from very distressed to, like, celebrations, etc. And some silver juniors are up, 100, 200%, like we saw Bear Creek pull a 200% rise. And like I said, I mean, I've said that this sector typically doesn't spend too much time at these extremes, which you can see. And sure enough, I mean, this was basically a straight shot. It retraced all movement since April in, a month or two. Well, was it quicker than that? Yeah, no, okay, maybe 1.5 months or so. So the declines typically are way longer than the actual upturns, except I guess this one, and this was kind of this COVID flash crash. But overall, it's like, just assume there's going to be 80% down action, and all of a sudden from nowhere, you get this up action. And of course, I mean, still today, I see people debating on, Twitter with charts, etc. Are we in a bull? Are we in a bear? Is this a fake rally? Is this are we in a bull or a bear? It's like, who cares? Who cares? I mean, we were obviously not in a bull down here, but it was still. I mean, this is peak evidence of not being in a bull. because the downtrend was the most severe and longest, obviously. I mean, that's the definition of a bottom. Uh, Nothing looks like a bear trend more than the actual bottom, and the bottom is supposed to look bottomless. Uh, so you think I cared if we were in a bear when I bought down here or bought down here? No. I know that sentiment always swings, sentiment always changes. This sector or no cyclical sector stays dirt cheap forever. And this right here might just be have been the best buy uh, in the last 8 years, and maybe in the next 8 years as well. So that's like when we get here, this was a massive, massive gift for anyone with, especially with dry powder. Like I've said, it's like buying here is exponentially better than holding, and holding is exponentially better than selling, because sooner or later this is gonna come, and it came. And now it has retraced after the GDXJ rebalancing. We're down here, and I would for sure not say that the sentiment in miners is exaggerated at all. I think miners have actually lagged the prices of metals, and then people read a bunch of stuff into that, like yeah, miners are suggesting it's a fake rally. Again, who cares? Sooner or later, more uptrend forms, and more people will get bullish, etc., etc. And the world is not getting too much better anyway. So I mean, the tailwinds are still very much in force. And we might, who knows, be going into a recession in 2023, and then you have the central banks responding perhaps, and all of a sudden even more money printing, yada yada. But that's not, again, what I focus on, because there's a million factors that gets thrown around on Twitter. And since everybody's talking about the same stuff, like rates, Fed, economy, yada yada, paper prices of metals in the short term, everybody thinks that that's important because that's what everybody else is focusing on. But if almost nobody makes any money, how much sense does it make to focus on what everyone else is focusing on? Try to guess, every single factor. And even if you're right, I mean, like the bear bottom of 2015-16, that gold and silver bottomed when they started raising rates. And of course, everyone has been kind of taught that, raising rates is bad for gold. Opposite happened. So let's say you start to short because everybody says that raising rates is a bad thing. Yeah, well, you would have gotten your ass handed to you. So again, I don't try to predict much else than what do I think it's worth, what's the price, what am I paying for everything today, because this is a scarce asset. I mean, gold and silver are scarce, but a serious gold and silver asset is much, much scarcer, because there's a bunch of projects out there. We know that supply is dwindling faster than production is put on, thanks to ESG and all of that, and the lack of capital in this sector. So I mean, that's favorable for gold, silver, and metal price. You've seen the LME inventories. I mean, nickel is at like 5-year lows. I think zinc is at 5-year lows. I think lead is at 5-year lows. I think tin is close to 5-year lows. So we're basically running out of inventory in almost all metals, and you don't see a bunch of those mines that mine that stuff get put on every day. No. So in my opinion, it's like, hey, if we go into a recession, maybe we'll have a price dip, but that means probably less capital, so it's going to get even worse, the supply picture, for when the next upswing in the global economy comes. If it all goes to crap, silver and gold are going to have a field day. If the economy kicks off, there's going to be more demand, and the supply again haven't kept up, so there's going to be, I think, more shortage and commodity inflation. So I simply think, due to ESG and everything that got us into this position, not being able to open any mines, etc. I mean, that's what makes commodities the no-brainer play, in my opinion, and that's why I also like to have not only gold and silver, some battery metals, etc. Copper, I like copper as well, but I'm primarily about gold and silver. But I like pretty much all commodities because, again, it's the supply picture that is very distressing. And I don't know which way we're gonna go. Again, we might have a recession first, and then they respond, and maybe global economy kicks off, and then you're gonna have even more money, but we're gonna still have low supply, so there's gonna be again maybe more inflation, etc. Because like in the 70s, inflation in the US went in like three big waves. Maybe we've had one wave, and let's say the economy kicks off again, or maybe we have a short recession first. Then the next inflationary period comes. So I mean, we're still not. I think we're in the end game, etc. But I still think we're not close to any, the last stage of an end game, because silver and gold haven't really ripped yet. I mean, silver isn't even over its 2011 highs yet. And I know what Felix Zulauf expects. He expects metals, gold and silver, to bottom in Q1 of 2023. So that's within just 3 months. That's a very short time period for a long-term investor. So even if somebody said, hey, we're within 3 months of a major bottom, and as Felix believes, there's going to be rising gold and silver prices through the end of this decade after that. So I mean, if you knew that, I mean, we know it's cheap already. We know the miners are cheap, so I don't care what. It's like I told someone after listening to Felix, because he's kind of a market timer. I love listening to his stuff. He has many good insights. The problem is that when you listen to a market timer, you want to be a market timer yourself. And I don't think that's the edge for anyone with, let's say, a smaller amount of capital in the mining space. Because again, these are so erratic that you have no idea really. Maybe metals, again, like gold and silver hasn't performed as badly as miners. I mean, these were no-brainers regardless of how poor the gold and silver chart looked. They were already pricing in like no margins in the gold space, and maybe a gold price of 1400 or something down here. Gold is at 1800. So I mean, there was already a built-in margin of safety because everybody was panic selling. So again, I like to hear that. I mean, that's confirmation bias, to hear someone, yeah, we'll have a major bottom soon, and then up for the rest of the decade. And it's like I've said to some people, I actually, when we're down here in the mining space, I don't mind confirmation bias, listening to bullish, metals pumpers, whatever. Because if that's what keeps you in the game, meaning not selling down here, rather buying, I'm all for that. Whatever edge you can give yourself to get the fortitude, let's say. If I don't think it's good to have confirmation bias to the upside here, for example, where it's like a correction down from overvalued valuations is more a matter of when, not if. This is where it's a matter of when, not if, that we go to the upside. So in that case, I mean, how dangerous is it to be listening to metals pumpers when it's obvious that they're gonna go up? And if you didn't listen to them, maybe you get scared like everyone else and sold. So it's like, I think confirmation bias can be helpful sometimes, actually, when you already know what really to do. Anyways, like I've been thinking, since we've seen silver rip, the sentiment get started, some juniors already kicking off, etc. The idea of, okay, how are you prepping for the bull, let's say. As you can see here is where peak merit of beta is, banked success. I mean, ounces in the ground are never cheaper than they were just 2 months ago, probably cheaper or as cheap as they were here. So like, every 8 years you have the best possible prices on banked success, sunk costs. And yes, we're up from that, but not all juniors went up 200%. So we're still early in the game, and still, I mean, ounces are very cheap in the ground. The risk success is very cheap. Like I said before, which I especially highlighted, when we were down here. If you look at some of the more advanced juniors, if you would recreate their success, it would cost more and take years to do than it would be to just buy them after the fact. So let's say at this point in time, a junior has drilled up 40 million ounces of silver, let's say. It took them, let's say, 5 years, or let's say 4 years, and cost them 35 million, and you could buy them at like 20 million. Obviously, that's assuming the project is actually legit, that there's a shot that these are actually valuable ounces. That obviously makes no sense. Nobody would be dumb enough to go out and actually drill for silver or gold or whatever metal. Still, we have a supply issue. So how does that jive? Like, okay, we have a supply issue. We have prices fairly high in the metals because of the supply issue. So forward supply or future supply, which is in the hands of juniors primarily, they're trading like they're almost, worthless. That doesn't make any sense at all, and that's why it was such a screaming buy. Like, hey, I mean, these ounces in the ground are going up in value every year. And still you can buy stuff at this point in time for less than it would cost to actually drill and prove it up. And you could get it immediately. You didn't have to wait for 4 years of drilling. And you didn't even have to take any risk, because we already know that the company has like 40 million ounces of silver or 2 million ounces of gold or whatever. So it's just an absolute no-brainer. I don't care if anybody suggests we're in a bull or a bear or what the rates are gonna do. That's just a no-brainer, absolute no-brainer. And I think people that bought here are gonna get paid a lot for it. Already paid in some juniors, but I'm looking for the, again, long game. And what keeps me from selling too early, let's say, is that, let's say a company has gone up 100%. Okay. Let's say it's still cheap or relatively cheap based on what is confirmed today. So let's say it's at fair value, but this particular company, you expect it to grow 200% in value over the next 2 years. So I'm like, okay, in 2 years, this is going to be worth 200% more than it is now. Why would I sell that if it's fair value based on what is confirmed? Because in my mind, I'm like, I have 200% as a base case expected return in store for me over 2 years. That's a fantastic result. So that's what keeps me from trying to time every top and time every bottom, etc. Because I always have a bigger payday, a longer time frame in mind. I'm bullish on the company itself. I'm bullish on the company in 2 years. Because if I was in a trading sardine, pure trading sardine, I would be probably scared to death, because I know it's like, hey, if let's say if this was the medium term top, which it ended up being, obviously, it's like I would feel like, hey, these guys are not going to create any value. So if I'm wrong here, we're going to go down to, let's say, this point, and then it's going to take a while to get back here, and I'll have to wait quite some time to get my, let's say, 50% return. Obviously, if you buy a trading sardine at these levels, I mean, even if it takes 1-2 years, that's going to be worth it anyway. But that's the beauty of cheap prices. You get less downside, less time to the actual upturn again, and you have higher returns. So I mean, just buying cheap and buying cheaper, just relentlessly buying cheaper. If something is already cheap and gets cheaper, I mean that's the best defense and offense you can have, because it always sorts itself out pretty much. And again, if you care about always having to pick the bottom, etc., you're never gonna buy these lows. None of these lows really look like typical lows, and especially, I mean, instead of, let's say, averaging down here, when you're like, oh, okay, this suddenly became the best buy in like 8 years, you would be obviously piling into beta stuff, regardless of how the short looked, and then all of a sudden you're up, and then all of a sudden you're up 200% from this level. So I mean, if you average down all the way and you have a average here, I mean, that's still a good return. But point being is that I personally find it very hard to ride pure beta plays, because I feel like I'm a gambler, pretty much pure gambler, unless we're down like at extreme levels. But up here we're in no man's land. It's like we're as close to, let's say, yeah, it's fair valued here, and you don't know if it's going to go up there or back down here. And if it goes back down here and this company cannot grow its value at all, you have no cushion, you have no value forcers to force her to the upside. And as we have seen, some juniors, even though the sector overall has been absolutely dumpstered, some have created so much value that they actually go flat. And then obviously you have the option, if you have some companies that have gone like this when others have gone like this, you have the option all of a sudden to, like, again, wait for the market to give you opportunities. That's what I talked about last video of volatility. The price changes is not a curse, it's a blessing. They offer up opportunities. You don't need to predict that Bear Creek or juniors, beta juniors, would get to this point. But when you see that they've gotten to that point, you should see that as, wow, okay, all of a sudden I didn't predict this, but wow, what a massive opportunity Mr. Markey gave us right here. And again, you maybe have some that perform like this or whatever. You could trade into stories like this, etc., etc. Now, all of a sudden in Bear Creek, for example, when we were up here, I wouldn't be piling into Bear Creek after a 200% run, because the risk reward is getting poorer because price has gone up quite a bit. But there are other stuff that are quite cheap. But again, to the point of, like, fast forwarding the tape, that let's say you have 4 silver juniors you like. Okay, they have equal amount of ounces right now, perhaps. They have somewhat the same prices. They're valued somewhat similarly. Okay, but let's say the 2 are very mature and they can't grow much more. They can't create much value over the next 1 to 2 years. But one of the 4, you think, hey, I mean, they have just begun de-risking and exploring their project, and they already have X amount of ounces. I would be much more comfortable owning that in that case, because then I have something to look forward to. Then I have, a belief that, hey, this company is going to be worth more in the future. So even if the sector sentiment is at the same level, I would expect it to revalue higher because they create more value. Whereas a mature or stagnant company shouldn't really change much in price because value doesn't change. And if it's a very poor company, let's say poor management, who typically destroys more value the more time you give them, the lower price is going to be. So the time is the enemy of the bad management team and the friend of the good management team. But some other points. Okay, prepping for the bull. Like, okay, let's play with idea. We have started another bull market, or that Felix Zulauf is right, that bottom in metals in Q1 next year within 3 months, and then we have basically a ramping gold and silver price for the next 5 years. That means that the next 3 months is all about just buying the cheapest stuff that you think will go up the most, obviously. One is obviously high beta, Monster Resources, that's banked success. Because like typically when we go into a metal frenzy, and people throw around, hey, this company has 500 million ounces of silver. That's what got me into Bear Creek in 2015-16, and that got handsomely rewarded. Bear Creek didn't change. It was just that they had one of the biggest silver resources around. So once silver sentiment got going and greed got going, people like the biggest resources, because you can see, hey, at $30 silver price, this deposit is worth 1.5 billion or whatever, and you could have bought it for like 60 million at the lows here. That's a lot of torque. That's a lot of bank success. A lot of metals that reprices with a rising metals price. That's high beta. Typically, again, those are not value creators. I mean, Bear Creek Mining still hasn't built their I think it's called Korani, their Korani silver project. I don't know if it will ever get built actually, but people don't care really. People look at, hey, this was trading at 100 million, and now this deposit is worth 1.5 billion. This is worth a lot right now, and it's going to be worth even more, $50 silver. So that's obviously one way to play it, and obviously the best time to buy it would have been here, here, and here. A bit less now, even though it's coming down again. So from the idea of expected future return, assuming we're gonna hit this, from here maybe 200%, which is very good, of course, but down here it might be 339%. So even though it's just 1 week worth of volatility, the expected future returns in this sector, because price changes, is massive. Let's assume you get 100% extra return within 2 years from here than here. 100% over 2 years. So fantastic result. 300 is mind-blowing in 2 years. 100%, given that the market average is 8 to 9%, just the price change in Bear Creek Mining theoretically opened up an additional 100% future return from here than here. That's worth a few years worth of good returns. So that's why it's like volatility is, although almost everybody gets taken advantage of volatility, that's literally how you beat what helps you beat the market long term. That's your tool. The panics and the mini panics and mini greed rallies in the short term time frame really makes a difference. Take this volatility here. This was a 68% return. It went down here. That's a fall of 56%. So everybody who held these stocks, like, oh, if you bought here, like, Jesus Christ, I just shaved off 56% of my position. But if you would have bought some down here, for example, taking advantage of this volatility, that could have returned 300%. So let's say you add just 5% or 10% to your position down here, thanks to price volatility going down. Let's say that has an expected return of 300%, and it only took August, December. Well, this is 8 months, but okay, that doesn't sound like a short time frame. But imagine having 300% in 8 months. That's absurd, an absurd return. So yeah, I hope I'm hammering this stuff in now. Like, the volatility is not a bad thing. that's why I, tweet sometimes when you have a very, let's say, poor market day, especially poor market day since we're in a buy zone anyway. It's like, okay, what prices is Mr. Market offering us up today? If I see a completely intact, confirmed case, one of the better cases out there, that goes down 20% because gold and silver are down 3%. That, to me, is a massive opportunity. If you pay 20% less and the story is intact and it's going to go to the value it's going to go regardless of what the volatility was on any given day, that 20% discount might amount to 80% additional returns in that story over the next 2 years. 80% returns are massive over 2 years, just from one day of a minus 20% price action. Of course, it's hard to like always get the bottom, etc. But hey, if you get it at 10 to 15% discount, that might be 40 to 50% additional returns. And also blue sky potential. Okay, what happens in a bear? What do people think here? Everybody's focused on risks and not losing money. Success that has yet to happen yet, meaning potential, that is the riskiest thing, riskiest value version. So down here, nobody cares about success. People aren't even fairly pricing in what has already happened. Banked success. 100% de-risked success even gets a discount. But potential, blue sky potential, exploration potential, that gets priced at pretty much zero, absolutely zero. And a lot of anything that could go right is not reflected. That's when you see companies kind of, some trading at cash levels. Meaning that Mr. Market is saying there's absolutely no chance that any of this is worth anything, and there's no chance of you doing anything that's going to be worth something. So blue sky potential and pure exploration stories tend to get hammered a lot here. You see, companies going down to 2 million market cap, 1 million market cap, even though they might have a large land package, they have some smoke, they have some soil samples. Market doesn't care. Nobody thinks about what the upside potential is. Up here, everybody thinks about what the upside potential is. They're not worried about losing money up here. They're not worried about where price is and what value actually is and what is confirmed, etc. No, all they're thinking about up here, which is typical of a bull, is how much more money they can make. I mean, there were people obviously buying Tesla at PE, I don't know, 1,000, because they still clung on to the idea that, hey, if this, and this happens, Tesla might go even higher. They weren't thinking that, hey, if this retraces to fair value right now, I'll probably be down 70%. No. So even if there's a slim chance that something might get even more valuable, that's what keeps them in the game at these levels. And if there's any risk at all that something might go south, some negative news might come, or something that can go wrong, which is already beyond priced in. That risk is beyond priced in here. That still makes them, not buy. That makes them sell, because any risk is too great of a risk here. And any upside potential at all is enough to buy up here, because everybody's focused on what can go right up here. Here everyone is thinking about what can go wrong. That's why people buy high and sell low, because this is where they are thinking about the upside, and this is where they're thinking about the downside. And when we go into a very hot environment, blue sky potential is a good weapon for anyone who bought potential for free down here or cheap here. Because, okay, if nobody cares about the upside potential now, when we get into a hot market environment, the market might be pricing in 3 years of future exploration success, which has yet to happen. So I like strong narratives, let's say. And we've seen that in cases. We've seen that in SK, and lo and behold, the SK mining case is pretty much intact. They have so many targets. The assay results recently, they were subpar, but they show that, hey, there might be more to this Jeff system, for example, since they hit like 800 meters away, which is a long strike. But that was punished very harshly. But imagine that SK Mining, gets a season or two more, makes another discovery, and given the amount of targets, etc., they have, and the idea of another SK Creek type deposit, or at least a Skeena type deposit, when we go into a hot environment, that kind of narrative can bring in a huge premium, because everybody is thinking about, hey, what happens if they actually find a multi-billion-dollar SK Creek deposit? But that's also why these, or stories like that, if they go from a premium, narrative premium, let's say, to a market that for some reason thinks the narrative is ending. I mean, again, it's like 3 days ago, everybody thought the sky was falling in SK Mining, even though it was pretty clear that the story is far from over. And if they have some kind of success and we go into a hot market environment, I think people buying at 70 cents, and that's why I wrote that in the channels. Like somebody said, now people who bought 12 months ago regret it. It's like, yeah, you're a hindsight investor, but people who buy it, sell at 70 cents, I think they might regret it in 12 months. Why? Because it, in my opinion, became too cheap for an pretty much intact story. So that's one thing I really like, and consider that, because okay, if you pick some companies and you see, hey, this story has a lot of blue sky potential, just keep in mind that when we go into a really hot environment, people are gonna pay up a lot for blue sky potential. Because as always, if something goes up, the more something goes up, the more of a positive spin it will catch, because Mr. Market is suggesting to people this story just gets better and better, and then people interpret that to, hey, I mean, people use the price action as due diligence, like, hey, people are saying this is just getting better and better. That must mean that blue sky has a higher probability of materializing. So if you have huge blue sky and a hot market environment, there's no price that is too high, pretty much. We saw that, I mean, one of the best examples is Garibaldi Resources. When that got moving, it went to 500 million without a single assay result, because the more it went up, people just hiked up the expectations. First it was this is going to be the next Voisey's Bay, which is like a massive legendary discovery, got sold for billions, and then that got people to buy more, so the price just went even higher, the trend got even stronger, and then people were starting to talk about, without any assays out yet, no, this is bigger than Voisey's Bay. This is Norilsk, which is an even bigger, it's a Russian nickel operation. I think it's pretty much the largest nickel complex in the world. So you can see how that works. It's just, when price goes up, sentiment gets higher. The blue sky gets taken for granted and actually gets hiked up. So again, and I think I talked about that on K Report, that right now potential and blue sky potential, nobody cares about that. But if you can buy that when it's cheap around here, nobody's caring about upside potential and blue sky potential. When they do, the price delta from where you bought it to where it might be heading might be gigantic. So I really like blue sky potential stories because you always want the market, Mr. Market, the marginal investor in a hot environment to always have a big carrot in front of it that no price is too high. And sure, I mean you're taking advantage of other people's FOMO, if you know what I mean, but that's always going to happen. This is not going to change. If it's not you that's riding that, somebody else is riding that. And jurisdiction premium, yes, I think if the valuation is not absurd thanks to a very good jurisdiction, I think that's a very good thing to have in mind. We know Thomas Kaplan, the famous billionaire, believes there's going to be a bubble within a bubble, meaning there's going to be bubble valuations in miners in the better jurisdictions when the whole mining sector is in a bubble. That might very much end up happening, but we don't know, and there's a lot of things that can change. Jurisdictions can change, ESG can be harsher than one thinks. And I mean, I know some people who think Africa is actually the best place to have a discovery because there you can actually build mines. There's not, 1,000 NGOs and the ESG consultants that's trying to stop your project because people there actually want work. And mining is a very, I think, high-paid job in a bunch of countries in Africa, for example. So I kind of like Africa from that standpoint because there you can actually monetize any value you find, whereas in other parts of the better jurisdictions, you can have a lot of in situ metals, but there's like no way you're gonna ever get to monetize that. So in reality, that might be worth zero, even if you find something really, really big. And of course, less enthusiastic about pre-discovery plays that risk killing a story in a bull. If you can buy banked success with probable growth and high blue sky potential, that's like the holy grail, I would say, of cases right now. If you have a pre-discovery play that has like one juicy target, if you buy that, sure, it can go up, and it can go up on drill hype if sentiment gets better, but you also risk killing that story. And especially if drill hype is not in the market yet. Because I like to play drill hype sometimes when sentiment is good, but if it's poor, meaning there's not going to be any price ramp going into drill assays. In that case, you don't have any low risk returns, and if you hold into assay results, if it goes south in a poor market environment, you're probably going to get cut in half. And if you actually have good results, you're not going to get rewarded. So again, at low sentiment, and I've written about this, the market is rigged against us here, it's going to be rigged for us here. But this up here is when discovery stories, etc., and drill hype, yada yada, is going to play a big part. Down here is where you want banked success and not take any risks, because if you buy a multi-million ounce, tier 3 deposit here for pennies on the dollar, there's no real risk there. You just have to wait until you make money. That's not the same case for a pre-discovery play that has a 95% chance of failure. But it's going to be a time and place where drilling and the potential of a 10-bagger from just one maiden drill campaign is going to be in full force, and then you can play that angle. But we're not there yet, I would say, because some are already still lingering around the bottoms. So we're still at we haven't even crossed the midpoint here. So again, I think the risk plays are far superior than pure potential plays. But what I again prefer is probable growth and preferably some margin of safety, but also big blue sky potential for when this market gets really hot. I mean, just think about Snowline Gold, for example. Yes, it's valued higher than most juniors, but they have way above abnormal results. But imagine we go into a gold frenzy, fast forward a year, and they're like, yeah, we probably have at least 20 million ounces, which would make it, one of the largest discoveries in North America at good grades, and they have a whole district left. Nobody can pay too high of a price for that district when you have a, let's say, a 20 million ounce discovery already. I mean, think about it. It's like, okay, hey, everybody's scrambling for gold, and you have the largest gold deposit around, and you have 20 additional targets in your district scale or region scale almost land position. That's a lot of potential that people are gonna see as excuses to pay whatever price they can. I mean, no price would be too high because, hey, I mean, maybe they have 2 valleys, 3 valley discoveries. Maybe they're gonna get 5, and when the price goes up, people are gonna believe that's getting more likely simply because price is going up. So if you have a very long pipeline of targets or a very large blue sky potential, that is people are gonna use that to pay up. So if you can buy that for free almost at these levels, you can just imagine what the potential returns are going to be in stories like that when we go into a hot sentiment environment, where something blue sky potential is priced at 5%, and all of a sudden it gets priced at 200%. You know what I mean? So that's how I think about it. And overall, I still dislike like pure beta plays. I do want to see, if I'm gonna be really bullish and have conviction, I do want to see material value creation potential over the next 2 years, because in that case I don't even need to be right on timing, because the value creation is gonna bail me out. Because I'd like to see silver be down 10% or 20%, and a story has gone from a tier 3 story, grown 200% to a tier 2 story, and I don't expect to be down on that. Simple as that. And if we actually go into a bull, you can just imagine again when like blue sky sentiment kicks off and confirmed success, high beta gets a lot of torque, etc. So that's what I love about this space, like the theory crafting. I mean, I like strategy games, etc. But it's like, yeah, you can be a strategist in this. We're just front running what everybody else is gonna do at some point. We see what they think now because we can see the current price of everything. That is how Mr. Market currently thinks. The big returns are made when there's a big discrepancy between what Mr. Market thinks and feels right now to what it might think and feel 2 years from now, when stuff has happened that Mr. Market isn't even paying attention to, but we are. And if we know how people act in a high sentiment environment relative a low, blue sky potential, max discount, blue sky potential, max premium, confirmed success, max discount, max premium. Probable growth is like, that's the bread and butter. That's just to give ourselves play on the whole impatience angle, that people don't care about things that are more than 4 months out. So if we buy positive stuff that's 4 to 24 months out for free today, in 4 months that first catalyst is going to be now, and the market will care. And then there's going to be we're going to just tick all the catalysts up to 24 months that the market doesn't care or prices in right now, but we cared about because we know that future is going to be the short term sometime, and then people will care. We just simply care about it, let's say 4 to 24 months before Mr. Market and everybody else cares. That's like a patience arbitrage, let's say. So I think this is why I love this sector. I mean, it's so fun to just, in my opinion, the most exciting stuff is not the potential returns, etc. Even though it's a big bonus, of course, and I prefer to make money, but that's mostly to keep score. I just enjoy. I mean, there's nothing more exhilarating, I think, to find a really, really good case that you think you figured out how a story is gonna probably play out, and you feel like nobody's aware of it. You find a gem, a jewel. The hunt for the big cases is the most fun part, I think, and also all of this, just let's say, outsmarting the Mr. Market, how uses its mood swings against him, and using the changes in beta and blue sky valuation, etc. That's also part of it, because that's not tied directly to any particular company, but those are still tools to be used against Mr. Market. Big rant again. I hope I tried to hike up the volume in the mic a bit. I have a new computer, so I guess the default settings were a bit low. But let me know if this is also too, let's say, muted, and I'll try to increase the, I guess, microphone volume. Consider me biased. Do your own due diligence. If I mention any companies, assume I own them. Assume I'm sponsored by them. Assume I might buy or sell them at any point in time. I don't share your profits or your losses. Everyone must take responsibility, because as soon as we blame people, we stop taking responsibility, and then you're just going to be a shitty investor forever. I never, personally, I don't think I've sent a single angry email to any management team, for example. I take, if I lose money, first of all, I think I get over it rather quickly, and I've taken some big baths in some stories, but it's like, that is already past. If I made a mistake, identify the mistake, learn from it, don't try to redo it, so you're gonna end up making more money over the long term anyway. But the important thing is to take responsibility and learn as much as you can, learn about yourself, learn about how other people are acting, and I just do some self-reflections. Like, again, I know that I'm not good with pure beta plays unless they're like absurdly cheap, because I feel like a pure gambler as soon as it goes up and goes down, because I don't think I have an edge. I'm just betting on the fact that somebody's going to pay more tomorrow, since I don't know if a trading sardine is actually going to be worth more in 2 years. So I don't even have that as a tailwind over the long term. That can't bail me out. It's only other people that could bail me out in that case, and I don't like those stories. So I again, personally know how I work, and that's why I'm not comfortable with pure beta plays. Even though I know some only play beta plays. That's not my cup of tea. I just know how I react when volatility comes. I end up I get emotional and make the wrong mistakes. I get thrown off. I sell too early and, sell low maybe, chase high, etc., etc. But the ones that I have made good money are the ones that I hold for a long time, and I believe that, hey, these can grow over the next 12 to 24 months on a rolling basis. Because yes, I have 50% corrections in them as well, but if they keep on growing, you're gonna get bailed out. You do not get bailed out in a trading sardine, as you can see here. You actually have to time. This price is no higher than this price. This price is actually lower than this. This is actually lower than that. This is actually lower than that. But in the meantime, there's huge swings when we get to extremes, obviously. Thanks for listening. Hit the thumbs up button if you liked stuff. Bye.